Thank you everyone for staying up after lunch. So we have a great set of people here, and the topic that we're going to focus on is that how have user metrics and how has growth changed in 2016, if at all, if at all it has or not. So one of the things that we were discussing outside before we started this is that whether last year was easy and this year is normal, or whether last year was normal and this year is more difficult, right? In a sense, it's a exercise in relativity, but why don't we start with that and then kind of go deeper into how user metrics, how growth, and how we do define growth as having changed from what it was last year, right? Shailesh, do you want to start off with that?
Sure. Yeah, I think last year was quite easy. And this year is not actually very, very hard to raise capital. It's probably a normal time. I mean, this is from the perspective that raising money shouldn't be super easy. If it is super easy, then almost anybody can do it, and industries get way overfunded, and the returns for everybody involved, other entrepreneurs, yourself, investors, all go down. There's only so much money you can pump up into an industry before it returns really drop. So I think actually in India this year, most venture funds have raised capital in the past 6 to 12 months. So they all have a fair bit of dry powder. Everyone is still as excited about the macro picture of internet users and mobile internet and e-commerce and the broad trends that I'm sure we've all talked about in the past. And things are still growing as far as we can see. Things are perhaps even growing a little bit better this year than last year, given that people are more focused on sensible metrics. So I think it's actually it's a normal market right now. It's not a bad market at all. And actually, to build a company, much beyond raising money, it's a much better market than it was last year.
Okay, sorry, I forgot to mention, a bit of introduction about everyone before we start to the audience, because
Sure.
they might not have context.
Sure. Shailesh, Lakhani, I've been with Sequoia for just under 9 years. I am based in Bombay until Monday, and I moved to Bangalore after that. So looking forward to meeting more folks when I'm here.
Hey, this is Aakash. I'm a CPO for GO-JEK. Most of you wouldn't know what GO-JEK is. It's a logistics and payments company based out of Indonesia. We are pretty large, actually. But yeah, we're focusing on just Indonesia at this moment. We have a development center in Bangalore, which is why I'm here in the first place. I used to work for a consulting company called Sequoia Engineering. We used to do product and development consulting. And we were recently acquired by GO-JEK sometime around November. So yeah, that's it.
Hi, I am Aaditya Sood. I'm the CEO and co-founder at Kamayo. Kamayo is a DevOps automation platform for any kind of infrastructure that you run. We are based here in Bangalore and San Francisco.
Okay, now, Shailesh kind of answered part of that question, so would you like to take a shot at it?
Sure. So specifically in compared to 2015, looking at the companies that got funded and what we are reading right now in the news media, which is probably why the perception is also there. I think a lot of concerns or criticism that we see is actually on much larger companies than the companies which are getting newly funded. So I don't think, I actually agree with him that it's not that it has become incredibly difficult to raise money. The bar is certainly set a little higher, and people are looking at, as he put, more sensible metric. So yeah, that's my take. A lot of things have changed for much larger companies, but at the entry level, I don't think really things have changed dramatically.
So what about B2B? Has it significantly changed? Is there any kind of difference at all?
I think at a very high level, it's not changed that much, but at a B2P, and I can only talk about from the sector that we are playing in. Given we have global markets, and the global play space area as well, right? The pendulum has swung a bit too far, and that's because of the public markets in US and China have not done that well. And there's still some amount of uncertainty, and this is the conversations when we have with investors and other companies in US in the Valley, is that there's still some amount of uncertainty on when have we hit market bottom or not. And the other indicator we see there is the US presidential elections, till that there's amount of uncertainty. So we see, at least I see that yes, it has become harder than say it would be next year.
So one of the things that we briefly touched upon while we were discussing also was that vanity metrics, or even stuff like a good founding team, or or a great set of people coming together, or an exit in the past. A lot of what we typically call as vanity metrics, or even initial downloads of 100,000. A lot of that has kind of disappeared, in the sense that people are looking at least a bit deeper into some of those metrics to make sense of whether that actually is going to result in continuous growth if we fuel the company by funding, right? What are your thoughts on terms of has that, or is it just that people have become a bit more reticent after last year, or is it just going back to what should have been in that sense?
Yeah, look, I think we've all learned what metrics, or well, maybe not learned, but are getting better at learning what metrics are important and what are not. And in the end, we're all trying to build businesses. So the financial metrics that are the outputs of all the vanity metrics that go in are mattering much more today when we think of investing in companies. And so, look, I think last year, like you were saying, Pratyush, you could have got funded off if you had a good number of downloads, or you had a founding team with a bunch of quote-unquote rock stars, or even went to a great school. And I think this year you'll have a lot more scrutiny, like you should. It'll be much more about your idea, about the execution you have, and ultimately about the financial metrics that your business will generate. That's not saying if you have a social network type product, or a product with a huge traction and a great team, and you went to a good school, or even doesn't really, maybe school's not that important, but you have some of those same aspects that you're still not quite interesting to investors. It's just that look, companies in the public markets like Twitter, which have a huge number of users and generate a fair bit of revenue, trade at actually very low multiples because people are valuing other things such as growth and what ultimately happens to many of these companies. Like, clearly we have way too many mobile apps, and it's very difficult to get discovered in that world. And it's a mobile app now, I think we all realize, is much more like a website. And just putting up a website, that doesn't make you very special. There's a lot more you have to do to build a business. So I think, look, as an ecosystem, we're all learning what's important. It's, in the end, we have to build a business. So one of the quotes that I like from Sam Altman is that everything is a multiple of earnings one day. And that's the reality for all of us.
So what do you think? Like, in GO-JEK, for example, do you look at some of the metrics, like how many users have downloaded, or can you just maybe delve a bit deeper from a consumer side, and maybe I'll add to that a bit later, on how do we take each consumer, like, I mean, lifetime value is a great metric, but how do you calculate it? How do you see repeats coming in?
Yes.
And why is that important in a present scenario?
So I think the first thing to consider is a question like this is like, it's highly contextual, right? It depends on the market that you are in, the competitors you are with, what is the saturation of the market that you're competing in. What is the saturation of the market that you're competing in? Are you like a mobile-only product, or how frequently users come to your to platform? What is the average ticket size? Like, just hundreds of parameters which really give you a perfect answer that suits that particular business. So in that context, now talking about GO-JEK, what matters for us is the repeat business that we get, because we are in a logistics or transportation space, which means we actually expect each of our user to use us at least once a day, right? Like, that's the holy grail, if not twice a day. So everything is actually to optimize that one particular metric. Now, obviously, when we look at other metric like what is the average booking period that we have, how frequently my allocations are happening, what are the distances between my driver and the pickup location, all of these are in turn to drive this one metric because we can see clear correlation between if my pickup time is like 5 seconds, sorry, my allocation is 5 seconds versus allocation is 3 seconds, I can see a substantial difference in my user behavior. But at the end of the day, the guiding factor is that number. Obviously, the number of downloads and installations, all of these are very, very important. And these are substantially important when you are in a market where there is a lot of users who are not on either of the platforms and you're in the land grab phase. But there is a time when you come to a level where you say that investment in this is not really paying as much as investing in something else. So that's when you switch the gears. Not that this is any less important. So I don't really think there is just one thing that you want to look at. At the end of the day, you have to decide what is this one metric that is really going to define whether your business is moving in the right direction at the right pace or not. And yes, you will have multiple factors that contribute to it. That's at least how I look at it from the GO-JEK's perspective.
So if I could add some, some points around the consumer part of it.
Yeah.
MagicX, the company that I run, what it does is it enables people to do transactions through texting, right? So you text us and then we help you reach a product, which is either an e-commerce product or food or, recharge as fast as possible. So, this is an incident not particularly reflective of VCs, but I'm just giving this as an example. So one of the VCs that I went to, he's like, what is the average amount of time that a user spends on your product, right? I said, that's absolutely not a metric because we want him to spend as less as time as possible. He should just come, do the transaction, and then go back to whatever he's doing in real life, right? So a part of growth and a part of retention also is the fact that we need to focus on the right metrics as such, and one which is relevant to us. Like most others, so for me, the two things that are relevant from a long-term point of view for a consumer are what is the lifetime value that he's bringing to me on the platform, how much money does he spend so that we can get a percentage out of that. And second is how quickly does he do it, because obviously his life outside the app is much more important than what it is on the app. We are not a content distribution platform like Delhi Hunt or Times of India. You just come, do a transaction and go out. So as soon as we define those metrics clearly, I think that will help us refine our product better,
so
as well as
that's actually very interesting and very important point for something like GO-JEK, which actually does food delivery as well as logistics. On the logistics, we really want users to spend as less amount of time on the platform as possible and very less number of distractions, which is what you would probably love about Uber, right? It's not that you have to constantly be on the application and talk to the driver. We are also in the food delivery, where actually someone spending time on the discovery part of it, we want that to happen. But once you move into the flows, which is actually for ordering, we want to reduce that time as much as possible. So even within the same application, you actually go on nuancing it further and say that this is the flow where I want people to spend more and more time. This is the flow where I want people to spend really less amount of time.
I think that's a big positive of this year, that people are focusing more on the right metrics, whatever they might be for your business.
I'd just like to actually, your example remind me of an anecdote. So till Google came about, all the websites like Yahoo and Alta Vista and all these things were judged by how long the user is going to spend on your portal, because they were destinations. And Google was one of the first guys who said that that's not the metric we are going for. What we want is that to get people on their way as fast as possible, saving them time. And in the long term, the revenue model wasn't very clear at that point. Long term, that seemed to work out well for them. Yeah.
So we didn't talk about the B2B side, but what kind of metrics do you look at? And like, for example, what do you define as we got great growth this quarter? Or yeah.
So there are, I'll answer this question in two parts. Like one is in what kind of metrics have changed in the market side, and second is what are the metrics we track internally. So for us, because we are in infrastructure automation, if you're running on AWS, Azure, blah, blah, blah stuff, Docker, whatever, we help you automate it. It's a very sticky product. So the customer churn is very low. If you have automated something and your infrastructure is running on top of it, we have pretty much never had any customer leave in the last 4 to 5 years. For us, the metrics are one, what is the number of customers? Because the larger the number of customers, the more breadth you have. One customer leaving, it's better to have more smaller customers than one very, very large. I mean, of course, to a certain extent. The second metric we track there is that what are the number of servers or VMs or containers they're managing using us, right? So if we say that this customer has got a 6,000 server deal with us and he's going to pay us month on month or year on year recurring. But also very important is that what is the potential for growth? This customer might start out with, there are some customers we started out with the 100 server license, but then they scaled out to 2,000 because their total infrastructure size was that. So that's the other metric we track, the third metric, that what is the total expansion possibility within this customer. And that's why you want to treat that customer well, and it's not treat them as like a 50 server customer, because one of the challenges again in this market is no one goes and turns over their entire infrastructure to a new provider in day one. That's madness. That's a recipe for disaster. So those are the metrics that are important for us, not the immediate value that I'm getting out of this customer, but the potential LTV analogous there. The second part is one of the things that happened in the public market correction is that suddenly SaaS-based companies, their multiplier dropped from around 10 to 5. And before that, we have always had some amount of pressure from the market or push from everywhere that rather than an on-premise model, you have to go to the SaaS model because the SaaS model is fundamentally better and it's get a better multiplier. February sometime, I think the market collectively, mysteriously just decided that no, SaaS companies are not fundamentally better than on-prem companies, and in terms of longer historical multipliers, they have to come up at the levels of Microsoft and Oracle, which is around 4 to 5 or 6th multiplier you get. So these two, the first part hasn't changed really, what were the metrics we were tracking, but suddenly in terms of giving a higher value to a hosted customer and SaaS customer has come down. Now we treat both of them, the pressure has gone there. They're treated no stepchildren anymore.
A part of what you touched upon, I think, which is essentially, which is important for us as well, and for our consumer companies in general, is the dichotomy between user acquisition and retention, right? Because the way I look at it, and I would love to know deeper thoughts from all of you, is that acquiring customers and retaining customers are sort of orthogonal in a sense, right? Like you spend money to acquire customers, whereas your product has to be good enough for them to keep on using it and not kind of go away, incentivizing them to use it. I mean, not in the, giving back as a cashback, but, making the product so good that he doesn't want to go away, right? Or giving them such a wow that he doesn't want to go away. So maybe we can start with you, telling about what are your thoughts about, the acquisition bit, the retention bit, and considering the maybe cooling down of a bit of the funding scene, which is the one that you think is relevant in 2016 going to 2017?
So one is, I don't think you can really differentiate. You can't say that one is less important than the other.
Yeah, they're orthogonal, but yeah. So
yes, they're orthogonal, but okay. So it depends on, again, the phase and what is possible. For example, there would be a phase in your business when you are not actually able to see people who are coming in staying for longer, which means if you're going to spend whatever X amount of money and time in fixing that problem of just the acquisition without solving the problem of retention, you're just wasting money at that point, right? So you have to kind of go hand in hand, both of these. It also depends on what kind of business you are in and what is it that you really want to prove to yourself or to your VCs or to anyone, basically all stakeholders, as to when you start a business, essentially it's a promise saying that, man, this is what the business is going to become. And based on that, you have made your plans. Based on that, you have raised money. So depending on what hypothesis that you want to prove for that phase in your business, I think that is what is really going to answer that question. It's perfectly possible that I have grown GoFood, which is the food delivery business for GO-JEK, to a certain X orders per day. Now, beyond that, what we really, what that proves is that there is so much market available, right? Obviously, there are subsidies that are in play. Maybe there are new competitors coming in. So the next thing that we want to prove is how many of repeat customers that I can get, or what is the basket size that is really going to show me what kind of profitability I can project in the future. So depending on what is this one hypothesis that you really want to prove to yourself, you will decide what to invest in and how to invest in terms of marketing, in terms of feature development, the pricing experiments that you are doing. All of that depends on that one hypothesis, and that hypothesis will keep on changing. Right. Hope that explains.
Yeah, I think that's broadly what I would think as well. Like, it just depends. Like I think like your question on acquisition versus retention, it just depends for every business. Like I can think of one company in our portfolio, CarDeco, which has an app for people buying cars. You only buy a car for like a 3 to 6 week period between researching and closing a transaction. So they don't expect you to really keep the app forever. There are some features that you might want to use later on, but if you just use it for that small period of time and you stay engaged with them and then they become the main place you go to for looking at car information, that's actually good enough for them. Similarly, I was speaking to some folks recently who a lot of people had poo-pooed the incentivized acquisition channel for acquiring users and saying that those are very poor quality users. But if you look at it for certain types of transactions on a cost-adjusted basis, if you're thinking of life in terms of a transaction, you just want to acquire an app user to complete some sort of transaction, then sometimes incentivized actually works out better than the higher cost methods from Facebook or Google. And so it's, I think that everyone needs to think through what the right thing they're trying to optimize for in their business. And at certain points of time, like last year, you were rewarded for market share. And you had to run that sprint, that there was lots of capital available. And, I don't think any of the founders who did, some crazy discounting or crazy incentivization last year are actually stupid people. They were doing exactly what they were being rewarded to do. And at different phases of the market, at different phases of your business, you got to think about different things. And for some of these companies, it could be completely different. And retention may not be a good metric for them at all.
Okay. I mean, kind of one of my last questions is that we've seen a lot of, focus on growth as such in the Indian market for obvious reasons, starting from the big players like Flipkart, Paytm, etc., all the way till, medium-level players like Urban Clap, House Joy, all the way to like small players, right? So, do you think the Indian consumer, if you look at in a generic level, the Indian consumer has been pampered too much? He's been told that, expect cashbacks or else don't do this transaction, or else, has the growth been, in a sense, pimped up, in a sense?
I would say, of course, yeah. It's like, who isn't here as a consumer or recipient or a beneficiary of huge online discounts? And like, who doesn't love that? Yeah. Like the question sometimes we think about is that if companies were operating at normal metrics, like if Ola, Uber were not in a fare war, what would the actual market size of cabs be? If we all had to pay, 2x, which is roughly at least what I think is the right number, how often would you take Ola, Uber versus an alternative? And similarly for e-commerce, what would the realistic usage be? There's no great way of using this because in some things like Ola, Uber, they could probably charge a significant premium to what they are now because we're also used to the convenience and we'd still use it a lot. But there probably is some sort of fringe drop-off. Again, I was with an entrepreneur who runs a very successful offline business yesterday. And a great guy, he's built a large business. And his perception was that online is only for discounts. And the online customer only thinks of discounts. For his business, he advertised 0% online because he thinks that that's kind of like the low-end customers that I don't want, which I thought was a very interesting perspective.
Okay. Any thoughts, or I can?
Yeah. Just extending that, right? So the question is obviously like, why is everybody pampering these customers? So in my experience, specifically within GO-JEK, there are two scenarios, very distinct scenarios where you end up pampering customer. What do you mean by pampering is just subsidizing whatever they are consuming. One is if you have a competitor and you are in this market grab part and you want to actually get as many customers as possible, so you keep on competing with each other on discounts, which is the obvious one. The second very interesting one that I came across is if you are creating a new market, which means that you want your customers to change their behavior, you really need to give them an incentive to do so, right? For example, food delivery was not really a part of culture in Indonesia at all, right? Like all the orders that we have is basically latent demand. Like nobody really predicted that the business can take off this much. And the way you ask customers to change their behavior is give them something that makes them change their behavior, saying that, hey, I'm too lazy generally to change my behavior, but this is so good that I'm going to try it out. And they will try it once, twice, thrice, 4 times, and hopefully see a value for which they will come back to you even after you stop giving them that discount. At least that's the hypothesis behind all of these things. So these two are very distinct cases where I've seen, it makes sense to give those discounts. And Indian customers are actually getting it both ways. There are a lot of larger companies competing against each other, which is why they get pampered. We have new services coming in which just did not exist in India before. So they are also giving discounts. So it's all good for all of us as consumers.
But I don't think discounting is a sustainable strategy for anybody, anywhere in the world. It's something that you're right, you might use to jumpstart a market, and that's fine, and it's worked for several people. But obviously, you have to focus on the harder things, because otherwise, if it's just discounting, anybody can raise money and start your business. So it's perhaps what you're seeing some of this year is that the guys who only focused on that and didn't build the fundamentals inside their businesses are the ones at greatest risks. But if you use discounting well, and I think GO-JEK is a great example of using discounting well and building a bunch of things on the back end to make the business much more defensible and sustainable, you're actually probably in a very good spot.
So actually connecting this to the previous question of which metric you track, a good example of this phase change would be that once you have proved that there is so much market, there are people ready to buy, get food delivery at home, the next thing that you really want to track is, what if I stop these subsidies? Because that was the hypothesis, right? The very reason you gave subsidies is to say that I'm going to develop this market, and once I stop subsidies, the market will continue. That was your hypothesis. So there is a time and place where you want to test that hypothesis as well. So take your subsidies down and see what's happening. So there is a phase for that as well, because if the answer to that question is negative, then you really want to rethink everything.
You were mentioning about the incubator or the free for 50 machines that you do for corporates, right? So
yeah, well, we have a freemium model, so you can go to, I don't like doing product plugs, but thank you. You can go to calm.io, download a forever free up to 50 servers, VMs, go run your infrastructure better, get better sleep at night, bring some sanity into DevOps. But before that, outside the question, outside a perspective on this discounting thing, because we have been seeing this evolve and everything, and uninformed opinion really, is that one is that behavior change, how much elasticity is there, that whether the customers will go back, consumers will go back to their original behavior once the discounts go away or not. I think the answer to that question is worth a couple of $1 billion, either one way. So far, let's find out.
okay. Thank you, and would love to have some questions from the audience, and then if you could please tell which one of us it's addressed to, that will be good.
Yeah, can we please have a mic there, please?
So there was some conversation before that. I'm Shefali. I run a B2B focused home services company, and we are so-called competing with Urban Club, but it is completely B2B focused. So my question over here is, we were speaking about acquisition and retention. And especially in a way, the question is for the VC in the panel especially, that when there are one-to-one relationship and one-to-many relationship in a startup, there are like 20 or 30 odd B2B companies which are there. And one may be contributing a large amount of revenues. It will always be there, especially when you are just building it up. And when raising funds, some of the companies drop off. How do investors look at that scenario in a B2B focused business?
Sorry, I didn't quite get the question.
So in a B2B focused business, when some of the corporates drop off from the list because of any reason, it can happen, right? They have in-house, they have given it to someone else, cultural difference or anything like that, but the business continues to be as it is. How do investors look into it?
I mean, in B2B businesses, yeah, churn is something we think about a fair bit because customer acquisition costs are often much higher than for consumers. But if the math or the overall, customer acquisition cost to lifetime value of the overall cohort of customers works, that's perfectly okay. I mean, I think it's actually probably no different than any consumer business.
It doesn't matter, you're saying. Even if the largest client drops off from the list and it gets your revenue dropped by, say, 30%, which can be, it was 30% contributor of the business, hypothetically, then...
I mean, if there's a revenue drop and things customers are leaving it, that's obviously not a good thing.
Yeah, exactly, because it is a startup and you're saying you're working in B2B.
Ma'am, if I could just take one question from everyone, then, we could have a lot more questions.
Sure, thank
you. Could take it offline,
and I can take it outside.
Sure.
Can I ask now? The question is to the VC again, that in terms of, say, the different metrics being valued by the market. So certain companies which were strongly growing in terms of revenue at NASDAQ in US, they were getting good valuations. Certain companies which just had good number of users growth, something like a WhatsApp, no path to profitability, they were getting good valuations and it got bought over at such a high price. Then there are certain which are having earnings and they are getting good valuations. So where is the success formula? Is it the user growth or is it earnings? Because there are certain companies which are not showing earnings and growing pretty well in terms of valuation.
Everything in life comes back to earnings at some stage. And there's many ways you can become valuable through that, though. It could be by, I think Facebook may have felt somewhat threatened by WhatsApp because many of us use WhatsApp much more than we used Facebook. And I think it's not very hard to imagine how WhatsApp could have made a lot of money given the amount of usage that they had. So if you had that belief that this was a threat to your business and you believe that this could eventually make a reasonable amount of money, that makes it valuable ahead of its financials being that way today. But that's a little bit of the change that we see from last year to this year. That Aditya touched about it about B2B companies or SaaS companies and enterprise software companies. That people thought that the new age companies in SaaS would all overtake the existing vendors, whether it be Microsoft or Oracle or others. But the existing companies actually did a pretty good pivot to SaaS, and that impacted what people perceived that the new age companies could do, and that impacted valuations. I think there's a lot of factors that go into it, but in the end, it's about the earnings power of your business. And that's sometimes you can get a good valuation by threatening someone who has good earnings power. Sometimes you can get it by having great technology, but in the end, you have to make profits.
Okay.
Someone there had a question.
Hi, excellent panel discussion. My name is Madhu. I'm a physician with a lot of interest in healthcare technology. My question specifically perhaps is for the gentleman from Sequoia. Where do you see healthcare startups and healthcare technology startups? What's their outlook in the Indian market at this point of time? It's been a difficult market even in the US for healthcare technology companies to crack because of regulation, so on and so forth. Do you have any general thoughts on that? Thanks.
We're very excited about healthcare tech. We have a couple of investments, and we also have a number of investments in offline healthcare services. We think healthcare in India is much more like a consumer service because it's much less regulated. So the consumer decides on where they want to go, what service they want to avail, at what price point they want to avail it at. So we think tech has a huge role to play in enabling that type of transaction.
So one fundamental question, 100 rupees in 2015 versus 100 rupees in 2016. What's costlier as a startup? But, I mean, assuming that average 100 rupees, so now where do you want me to invest? So in 2015, you wanted as a startup to invest everything in marketing. Probably, 90% was going to marketing, right? So what's happening in 2016? I mean, where is that money? Where's the big chunk going? So Pratyush and Shailesh, I mean, Pratyush, because you run a B2C startups, angel funded, and Shailesh, obviously, because you have the money.
Okay, so as you said, we are a early stage startup. We are growing very fast. What we have seen is that people use our product once they cross one transaction, they use it very frequently, right? Like for example, if you cross one transaction, we have seen that number to about 3.2. So they do 3.2 transactions average. So for me, at least from the 200,000 odd sample set that we have, retention is going to be easier. So my point is that, is this going to be reflected in a 1 million mark? So right now, if I have 100 rupees or $100 million or whatever, I'm going to spend it on marketing to get those users, because at least in a smaller sample set of 200,000, I'm seeing that the retention is high. But again, it depends on the, initially we were good, or whatever, we were lucky enough to be like the top #1 new shopping app, which got us those initial set of users without spending much on marketing. And now that we have seen some amount of retention happen, I would spend it on marketing to get those users. But your thoughts?
I think 100 rupees is much more valuable this year than it was last year. Last year was probably easier to get or easier to raise. But I don't know if you would want to spend particularly less on marketing this year. I don't know if we've seen it yet, but cost of customer acquisition should reduce in many industries. So when fewer of your competitors are advertising, it's probably a good time to go out and get more users. Yeah, I think, look, overall things are, if you were doing things right in 2015, things shouldn't change all that much in 2016.
Great. Thanks for the panel discussion.
Thank you.
Did you have any final thoughts, Pratyush, or did you want to wrap it up? Or are we good?
I think.
Okay, great. Thanks to all the panelists, and thanks to the moderator. Just a small token of appreciation from our sponsors.